Hi, welcome to another episode of 2 Minutes on Tuesday. I am Sam Miller of REMAX Realty.
I'm Erica Miller of REMAX Realty.
And it's a new year. And because it's a new year, there's lots of people that are thinking about buying a home. They've set goals on New Year's Eve. One of the things they want to do this year is buy a home. And but a lot of them don't understand credit and what's required to have credit in order to qualify for a home. So in this episode, we're going to explain some things about credit that you might not know, and we're also going to give you some tips on things that you can do to improve your credit. So the primary thing I want you to think about is that when you're going to get a home loan, they're looking at the last 3 years of your credit and payment history and your financial status. So the last 3 years. Now, I want you to envision that you've got 3 different buckets on your table. So buckets. The first bucket regarding your credit is your current financial status. So your current bills that you pay each month. And if all your bills are current and paid on time, that's really important. That's one of the most important things regarding obtaining a home loan. So they look at that. So there's a lot of emphasis put on what your current status is. Then another bucket, so let's say bucket number 2, which is the second most critical, is your credit and your financial status from a month ago to the last 12 months. And they're looking at that for consistency to make sure there's no blips or craziness in your credit. So that's important, but it's not as critical as bucket number 1. Now, bucket number 3, the third bucket, that is your credit history, payment history, and financial information relating from 13 months to the last 36 months. So basically after the first year to the year 3, they want to know where you're at in that time period. And that is important, but not nearly as critical as bucket number 2 and obviously bucket number 1. So, and that's to put things into perspective. You can have some blips on your credit from 2.5 years ago that are not looked at as concerning as if they were last month or 6 months ago. So a lot of folks think, I'm doomed. I'm not getting the loan because I had a bump in my credit, 2.5 years ago. And that's probably not the case if you've established good credit and have really good payment history since then. Also important to know 2 things that are big misconceptions. One of them, student loans that are in deferment, meaning you have a student loan, but they haven't made you start making payments yet. So just because you haven't started making payments yet doesn't mean you don't owe. The lender has to count against you whatever that loan balance is. They're going to have to calculate a payment for your debt to income ratio because you're going to have an upcoming payment, and they're going to calculate that when they qualify you for the loan. In most cases, what I hear is about 1% of that loan balance is counted each month. So if you had a $10,000, it's 1% of that. If it's 100,000, it's 1% of that. So and then also, if you bought something 90 days, same as cash, you went to Best Buy over Christmas, you bought a new computer, it's $1,000, but you don't have to make a payment on it for 6 months. They still are going to count the minimum payment of that 90 days, same as cash, or 6 months, same as cash, or whatever it is. They're going to count a minimum payment against you on your debt to income ratio because at some point you're going to have to pay that payment. So they're going to count that. So those are important things that a lot of people don't think about.
Usage is something that a lot of people aren't aware of. However, it does have an effect on your ability to borrow money and your credit. So let me give you an example of what usage is. Say you have a credit card that has a $1,000 limit, and you've currently charged that up and you're at about a $900 balance. Now, in an ideal situation, you would want that balance to be closer to $300 because the rule of thumb is to keep your balance at 30% of whatever your limit is, at 30% or below that. When you have it around this range, then this is going to help improve your credit, and it'll in turn help you have a better advantage on borrowing money.
So something that is really important to understand is something called the FICO score ingredients. And basically what this is, it basically says your payment history is important, amount owed, what your balances are on any outstanding debt, the length of credit history, new credit, any new credit you might have taken, and the types of credit are all things that are taken into consideration. And you may want to pause this and look at the graph to see the percentages, but this is active, this is current, so it's very helpful for you to know that information. Also, collections. A collection, if you don't know, is where you've had a balance that's been due. Say it was your cell phone bill and you owed $80 on the cell phone bill and somehow you didn't pay it off. Maybe even didn't get the bill. Maybe you moved from one rental to another and the bill didn't catch up to you because you moved and had a change of address, but you have an outstanding balance, and all of a sudden that balance has gone unpaid, and after 6 months, a year, whatever, it became a collection where the cell phone company turned it over to a collection agency, and now that shows on your credit. If they're currently reporting that outstanding balance as a collection and it's on your credit every month, it's hurting your credit. So the sooner you get that squared away, the sooner that's going to clear itself up. Also, maxed out credit cards. You got a credit card that's a $1,000 credit card and you've charged $1,000. That's what you owe on it. That does not look nearly as favorable as, like Erica had mentioned, where if you only owe on a $1,000 credit card, you only have a $300 balance or less. That's looked far more favorably when you're getting a loan. So you don't want to have your credit cards charged to the max, because that works against you when you're trying to apply to buy a home and get a home loan. Also, one of the things you can do if your balance is high, you can pay it down. I mean, you have the ability over time to pay that loan down and focus on that and get that, where instead of owing $1,000 on a $1,000 credit card, you can work your way down to $300, and that's advisable.
So there's a few things you can do to help establish credit. And number one, and this is going to be the most important, is to pay your bills on time. Now, if you feel like that you're not great at managing money, one suggestion you can do is to do automatic payments. That way you don't have to worry about late payments, and the bills are getting paid by deducting the money automatically from your account. So, and this is something very easy that you can do. Number two would be you can ask a family member for help, and typically a family member can help pay towards an account balance. So this can help you establish credit. Three, do not work with a lender who's constantly going to be running your credit report. If your credit report is constantly run, then this is going to have a negative effect on your credit score. It's going to make it go down. So you don't want that. You want your credit score going up. And then finally is, if you feel like you don't qualify for a traditional credit card, you can apply for a secure credit card. This way that you can still establish credit, even though if you feel like you don't qualify for a traditional credit card. Thanks for watching this episode of 2 Minutes on Tuesday. I'm Erica Miller.
And I'm Sam Miller.
And we'll be back with you next week on a new episode.
Thanks for watching.